Appreciate it. Okay, folks, the man who needs no introduction. Believe it or not, he's been doing this for 4 decades already, 35 years in the industry, former chief equity strategist for JP Morgan. For the past 11 years, he's been the co-founder and the head of research of Fundstrat. The past 6 years, he's been doing a lot of work for retail investors like myself and you guys at FS Insight. Last year, he launched Granny Shots, the ETF. And as of June this year, he's the chairman of BMNR. So he's diving into crypto and Ethereum. The man of many talents. Hello, Tom. Good to have you on.
Yeah, great to be on with you, Tom.
So, Tom, I got to ask you a question here. Looking back, we're up about 80-something% of the past 3 years. What did the bears get wrong for the past 2 years as of 2023, 24? You've been one of the only voices saying, hey, this is going to happen. What did 90% of analysts miss about the past 3 years?
Yeah, Scott Bessent famously has said in the past that, 80% of a trade is macro, and so I think for the last 3 years, most investors took that to heart and became armchair macro people. But what threw people off over the last 3 years was a few things. Number one, they were too grounded in believing there's a science to the yield curve. The yield curve was inverted. Now, we explained at Fundstrat that the inversion was due to inflation expectations. Inflation was higher near term, so the nominal rate should be higher near term, but it would drop long term. That's why the yield curve's inverted. But everyone said it was a recession signal. Number two, I think what people got wrong is that we never had experienced inflation before. So everybody was anchored in 1970s as the template, not realizing that we didn't have the same intractable conditions to cause inflation. So I think people were structurally bearish because they're like, curves inverted, there's a recession. Second, we have stagflation. And then they missed that companies were real-time dynamically changing their business models to deal with inflation and a tight Fed. And they delivered good earnings. So I think Fundstrat, and our focus for our clients was, look, let's just find the best companies. They're not really going to be beaten up because of inflation. And that thesis proved correct.
I mean, you know what they say, time is the best friend of a great business, in the stock market at least, and the worst enemy of a crappy one. And that's true in inflation or in a bull market, doesn't matter. But I heard you speak for the past few weeks, and it seems to me that we're repeating some of the similarities that what happened in 2022 when everybody's starting to get bearish right now about this market. They're starting to get anxious. And you are taking a position again that you think that we are still in the bullish setup. And I know your work. I've been following your work. So I know you've been bearish before. People just haven't seen it for the past 5 years. So you can be bearish. That's the one thing I've been doing this for 30 odd years. What do you think people misunderstand the most about the current setup?
Well, I think what people have a hard time understanding and grasping are super cycles, because Fundstrat's work by nature is thematic. We look for story arcs that last 10 to 15 years. So the reason we turned structurally bullish in 2009, was because our cycle work showed that there was a long-term bull market starting. And beginning in 2018, we identified two future super cycles. One was millennials and the fact that they're entering the prime age workforce. That was a powerful tailwind that would last up to 20 years. And the second was there was a global prime age workforce labor shortage. I know it sounds like plain vanilla to say that, but that was going to set the stage for an AI boom. So we're in the midst of an AI boom that is causing prices to levitate. But this is pretty textbook. In 1991 to 99, there was a labor shortage and tech boomed. 1948 to 67, there was a labor shortage and tech boomed. So tech is booming, and a lot of people look at stocks that have a high Sharpe ratio, right? They're just going up, and they assume it's a bubble. And so people have been chronically trying to short NVIDIA every step of the way up. And then the second thing people anchor to is that, well, many people aren't really that old in our business. I was actually an equity research analyst during the dot-com boom. So many people are saying this is just like the dot-com mania. There's some similarities, but we're so far from it. But everyone thinks that this is based again. And the
I mean,
mistake I
you've been
think people
covering
make is they have to
telecom
understand.
in the late '90s, right? Which was the heart of the boom.
Yes, yeah, and I was actually helping doing the wireless sector, so they were part of that build out of the fiber and the cellular towers and the internet. I remembered that data networking analysts asked me, Tom, what is TCP/IP? Because wireless companies had to do some basic architecture. So this is very different because AI, of course, is gaining function. Internet wasn't gaining function. There was just a lot of spending.
Like I find it amusing when people draw the comparison between Cisco and Nvidia, because like if you look at it, telecom and GPUs, it's such a completely different life cycle, right? With telecom capex deployment, it's once in every couple decades, and then in GPUs, I mean, you're living through a new cycle every couple of months. It's insane.
Yes, that's right. So the thesis in telecoms back then, because people forget, because telecom was the capex boom, not internet. Uh, in the emerging markets, telecom spending was associated with GDP growth. So there was an emerging markets thesis around telecom spending that was in the mid 90s. But then that spilled over into the US digging up a lot of fiber everywhere on the railroads, on the streets. Many people were young, but they, Quest and everybody was laying fiber, and then they were laying fiber across the world with Global Crossing. The problem is internet consumption of that was not at all keeping pace with the explosion of the amount of fiber being laid. There was almost 99% dark fiber at the peak. Now, NVIDIA GPU usage, as you're saying, is pretty much 100% usage the minute they turn it on. It's a lot more like the Cheesecake Factory, where when Cheesecake Factory opens a store, it's at 98% capacity.
If Nvidia could increase capacity by another 50%, they would still sell out of every single chip.
That's right, because as you know, today there are three really binding constraints. It's NVIDIA chips, it's actually silicon surrounding it, and then it's energy, and all three are constrained. And then it's really not, maybe not the best word, but the gain of function of AI is actually progressing faster. So there really right now is capital spending is behind the curve.
Tom, I got to ask you a question. You said on multiple occasions that we might see 7,000, 7,500 on the S&P 500 by the end of the year. I mean, I take all of these with a grain of salt, as you yourself explained, that everything is fluid. But generally speaking, you're bearish heading into the final couple of months of the year. What do you think the sector that's going to surprise people for the next couple of months that they're not seeing it coming?
Yeah, Tom, I might have misheard you. Were you saying that I'm not bearish into the final few months?
I heard you talk about a bullish cycle going into the final few weeks of the year, and I heard you, I think, 2 weeks ago talking about 7,500 on the SP 500 as a possibility. But
Yeah.
again, I said like maybe 7,500, maybe 7,000, doesn't matter. But overall, you're bullish heading into the final few weeks. So my question is, what sector do you think is going to surprise people for the better versus the current
Yeah.
expectations?
Well, yeah, it's well, number one, as your viewers know, people have gotten pretty bearish in the last couple of weeks because the government shutdown kind of has deprived the economy of money. And then the Treasury Department isn't dispersing funds, so their liquidity has shrunk. And it's caused stocks to actually wobble. And every time the S&P is down 2 or 3%, or AI stocks are down 5, I think people get really cautious. I think, first of all, bullish sentiment is not even anchored properly. People become so hesitant. I think everybody thinks there's a top. Here's the thing: when everyone says there's a top, there cannot be a top. The top in the dot-com was because nobody thought stocks could ever fall. They actually thought we were entering like an era of continued prosperity. The second thing to keep in mind is that markets have been strong for the last 6 months. There is incredible uh, demand for equities because people are really off sides. That's what you have to keep in mind. In April of this year, people thought we were facing Armageddon because of tariffs, and you had many economists proclaiming a recession, and that's how institutions traded. They were actually
Yep.
positioned for a massive bear. They can't fix that in 6 months. So we're now getting into year end where institutions, 80%, are trailing their benchmark this year. It's the worst performance for institutional fund managers in 30 years, and they have 10 weeks to fix it. They're going to be buying stocks. And finally, visibility for AI has not even been affected by the government shutdown or anything. So companies are going to start, as they think about 2026, start making announcements. So I think in the final months, like I think one surprise is the AI trade's going to come back strong because it's wobbled. But the Fed is getting people scared because is the Fed going to suddenly hammer down on things? But keep in mind, inflation has been softening. So if they cut in December, they're confirming they're on an easing cycle. Now that meeting's not for a few weeks,
Yep.
but that would be really bullish for financials and small caps. And by the way, what's correlated to tech and financials and small caps? It's crypto. So I think you're going to have a massive crypto rally as well.
How far do you think we get on Bitcoin by the end of the year?
Well, I think people have dampened their expectations for Bitcoin because partly because Bitcoin's been treading water, and there have been a lot of OGs, original Bitcoiners that are selling above 100,000, but it is still an underallocated asset class. So I think Bitcoin actually potentially can get to the high 100,000s, maybe even 200,000 by the end of the year. I think it's a big ask, but to me, what's more obvious is Ethereum uh, can have a huge move into year end because even Kathy Wood wrote about it. She thinks stable coins have been cannibalizing demand for Bitcoin, and gold and tokenized gold is cannibalizing demand for Bitcoin. But stable coins and tokenized gold run on smart contract blockchains like Ethereum, and Wall Street is building, and Larry Fink wants to tokenize everything on the blockchain. That means Ethereum is where people are starting to raise their growth expectations. And if you're raising your growth expectations, then your discount to the future is going up. So I think that there's a bigger move in Ethereum, and Mark Newton, our head of technical strategy, thinks we can be like 9 to 12,000 by January. I think that's about right. I think Ethereum just 3,600 more than doubles between now and year end, or between now and January.
And the thing you pointed out earlier, and that's the part I wanted to ask you. I've been fascinated by this question. So obviously, just to recap what you're saying, you look at the fear and greed index. We closed Friday on 21. We're at extreme fear. You look at the Fed CME watch tool. It says, yeah, 70% chances of another cut in December, and everything is rallying. And you're saying, well, it doesn't add up, right? So you mentioned this, and I keep explaining this to my viewers. If you're managing money for very wealthy individuals, right, you're getting paid 2% AUM and 20% carried, you are expected, at the very least, to not lag the S&P 500, right? So as you pointed out, there's a huge game of chicken going on now for the past 3 years, 23, 24, and so far this year, with professional money managers essentially trying to will their way on the market, and they're essentially doubling down on this bearish position, saying, "Oh, it's coming, it's coming." So, I think at some point, as you point out, you have to make the call to say, "Well, we got it wrong. We have to jump in." And as you pointed out, I think towards the end of the year is where it's like the championship rounds in boxing. This is
Mm.
rounds 10, 11, 12. It's going to happen then. I agree with you. So my question to you is, do you think that that also spills over to cryptocurrencies as far as Ethereum and Bitcoin, that institutional participation?
Yeah, I do, Tom. One thing you're pointing out, and that's correct, is that 2025 is the third year where the S&P will be up double digits, probably up
Yep.
20% this year. So 3 years of 20% gains in a row. Okay, remember at the end of 2022, people were saying we were Armageddon. Nobody was bullish. So in the last 3 years, wealthy individuals and hedge funds recommended people go to cash or they do alternatives like private equity, private credit, or venture. But the S&P 500 has trounced all of those categories of assets. So this is a comeuppance because 3-year return. What is someone's excuse for basically maybe having flat performance or up 15% when the S&P is almost up 200%? So this is really the reason 2026 is probably not as bearish as people think, because now next year I think people are going to be like, wow, wait, Nvidia and all these are public companies, and their earnings are growing 50%. I think people are going to actually start chasing them next year. That's really positive for crypto because, as you know, there is also this argument today that the crypto cycle is a 4-year cycle, so it should be ending now. So
Yep.
people are trying to fade that. I think people are trying to fade everything, the S&P and the crypto, but forgetting that the Fed is beginning to cut, and the ISM, and we've written about this, is more correlated to Bitcoin than monetary policy. And until the ISM gets to 60, Bitcoin really can't peak. So I think this is pretty positive for crypto. But crypto, it's kind of been hurt because, monetary liquidity hasn't been really increasing. The Fed has been under QT, quantitative
Yep.
tightening. That's ending in December. And the Fed hasn't really given clear signals that they want to ease. So I think there's been a little bit of confusion for investors. That
Speaking
should be
about
ending though.
speaking about confusion for investors, what do you think is the most overblown, overrated risk right now in the stock market that everybody is harping on?
Uh, I mean, I would say if I had to say what is the most overrated risk, I think the most overrated risk is that inflation's coming back. Um,
I thought
and
you were gonna say
I
that.
mean, I know, huh?
I thought you were gonna say that. I had a bet on that.
Okay, well, maybe that was a polymarket bet. But the reason I think it's overrated is I think too many people think monetary easing cycles create inflation, or they think GDP growth creates inflation. But inflation is a very mysterious thing because we had a lot of easy money for years and there was no inflation. And now that the labor market's softening and the tariffs basically were supposed to create another wave of inflation, it hasn't. And housing is now tanking. How do we get inflation if the big drivers are housing? The big drivers of inflation are housing, labor costs, and then goods, but none of those are inflating. I heard a Fed speaker last week say core services is inflating again. We checked it. That's dead wrong. PCE core services is now running at 3.2%. It's been long-term 3.6. It's actually running below average. And core services generally runs above 2% because goods offsets that. So I think that there's a false belief inflation is actually strengthening.
Do you see a? I want to be devil's advocate here for a second. And what about a curveball that comes from oil? Let's say geopolitics, wars, supply chain, oil shoots up. Could you see a scenario where this makes you bearish if that happens?
I mean, there is a possibility. Oil, if it goes high enough, can create a shock. And so, if you look at the last three cycles of shocks, inflation shocks, uh, sorry, the last three non-Fed related economic
Yep.
shocks were commodity shocks. But oil has, as a burden, has to become meaningful to households. So, in the last few years, the energy intensity of the economy has actually shrunk. So oil needs to get close to 200 to create that shock. $100 oil, we got close to that. It
Yeah.
doesn't create the shock. Um, you really need to be getting. So could oil triple on a geopolitical? Maybe, but remember, this summer the U.S. bombed Iran's nuclear facilities, and people had said that if the U.S. ever bombed Iran's nuclear facilities, oil would spike to 200, and it barely
Yeah.
budged.
It's again, I'm young, so I haven't been around for the past 100 years. But one thing I can say, just destroy my own kind of devil's advocate argument, is like geopolitics have never long term slowed down the U.S. economy or the U.S. stock market. We had like local shocks, but I mean, we've never had geopolitics cause an actual recession or big stock market crash in the United States ever.
Yes, that's right. Geopolitics can crash unstable economies. I mean, it makes sense. Like, if
Yep.
you're looked at like Asia, anytime there's been like a revolution, like the stock market
Yep.
crashes. And I think a lot of people think the United States is a banana republic, but as you know, the real key is, are companies' earnings going to crash because of geopolitical tensions? And if they don't, then I think we should stop, like you said, overlaying that as a principal reason we could have a bear market.
Yeah, you know the famous chart Josh Brown put it up, the one that he superimposed all the crazy things that happen in the world on top of the S&P 500, and then I think it's a beautiful chart. I love his work. Shout out to him. So I
Yeah.
want to ask I want to ask a question based on what you just said. So we were talking about, the Fed is there's a good chance the Fed cuts. The market is pricing that in, as Fed CME has it at 70%. What happens if Powell throws a curveball and doesn't cut in December? Does the market react negatively to that?
Yeah, in the short term, Tom, that would. But as you know, Fed Chair Powell, now he's done a good job as Fed Chair. But as you know, he's not popular with the administration. So there's a good chance that he is a lame duck Fed chair, and there's going to be a replacement named. I think if he doesn't cut in December, the White House is going to accelerate plans to replace the Fed chair. So the odds of a quote shadow Fed go to 100%. And
Yeah.
that new shadow Fed will be establishing monetary policy. So I think there isn't going to be as necessarily negative repercussions, because I think the idea of a new Fed would be one that doesn't have to be ruled by all the voices of the Fed either. There may be a shift in the way monetary policy is conducted.
I think people in general put too much into what Powell says, how he says it. I think there's over analysis of his televised speeches. I think it's an obsession that needs to go away, but that's just my personal opinion. I want to ask you a question,
That's
Tom.
pretty wise
Uh,
advice, Tom.
yeah, it's overanalyzed. Come on. But I do want to ask you a serious question. I've been getting a lot of calls from family members, from close friends, saying, "Look, I'm sitting in cash. I've been sitting in cash since 2022. Should I give up and jump in right now? But everybody keeps telling me the market is too high. What should I do? What's the Tom Lee answer to that conundrum?"
Yeah. Well, and it's actually a great point, because I think a lot of people have this dilemma. And by the way, when I was at JP Morgan and I left in 2014, the bull market bottomed in 2009, and even in 2014, 6 years later, or 5 years later, there were many people at JP Morgan that were still sitting in cash, and they were becoming desperate because they didn't know when to start getting into the market again. So it's highlighting two things, and I'm glad you brought it up. Number one, when you sell out of stocks, you've made one decision. Now you're forced to make another decision. Are you smart enough to re-enter at a better price? That's the reason you should never panic sell, because unless you're positive you'll make a tactical re-entry, you've now sat out a compounding. And as Josh Brown's chart shows, every crisis was always an opportunity, not a time to
Yep.
sell. But the second is, if you're in that position, you have to accept you've made a big mistake. And the minute you accept that, then the way you fix it is dollar cost average. So you now have to reestablish your position, but I wouldn't do 100%, and I would not be tempted to say, I'll wait for a correction. Do you know how many people are waiting for a correction? So I would not put 100% back into stocks, but dollar cost average means take 12 months and then do
Yep.
1/8 or 1/12 or 10% every month. And then you're back into the market. And that way, if there is a dip, you can actually take advantage of that.
It's funny you should mention this. I know you don't watch my videos. I mean, not all of them, but I'm
I
kind
like
of
your work,
known as.
Tom.
Thank you, appreciate it. But DCA is kind of my thing. So when you say that, I feel like I can say great minds think alike, but I'm not. That's as far as going to go with that. But do you think that this market is weird for me to even ask that because when I grew up, like retail never drove anything. We always were like kind of the dumb money. Is it possible that this bull run is mainly driven by retail right now, and institutional investors are still on the sideline?
Well, I'd like to correct something that people have said because I've been in markets, as you know, for 35 years.
Yep.
And I've never thought retail was wrong. I grew up at Smith Barney, which was what they call, quote, a wirehouse system. So there was a lot of retail investors. That was their order flow was probably 50-50, institutional retail.
Mm.
Uh, in the 90s, retail was always right. So the reason is I think retail, remember, I'm generalizing because there's a lot in retail. There's
Yeah,
like
yeah, of
zero-day
course.
traders, and there's Robinhood, and then there's Schwab, and then there's high net worth. But the reality is the person who's buying stocks because they have a long-term view of stocks is going to get this market right.
Fact.
There are more of those people in retail than in institutions because the institutional investor has a monthly bogey they got to beat, and
Yep.
they're under pressure to beat their peers. So sometimes they forget that Nvidia is just a long-term buy. They're trying to time the market. So I would say anyone who operates with a long-term view is the smart money, and that's been mostly more of those folks are in retail.
When I was advocating for Palantir, so I started talking about Palantir right after the DPO launched, and it's funny. I went through every possible emotion ever. DPO comes out, we start talking about it. I say, hey, this is a $1 trillion company. It goes up from $10 to $40 per share. I'm being hailed as the greatest genius in the history of the stock market. It then drops to $6. I'm getting death threats, and for that whole year, I've been saying, hey, be patient. It's all good. You're getting a discount. Just look at the long term of the business, the fundamentals. The price is not that important. And now we're back. I'm back to being genius, and when it corrects another 50%, I'm going to be back to being hated again. But the fact of the matter is, anybody who looked at a company, whether it be Palantir, Nvidia, or Tesla, on the long-term view, and they've analyzed the business and ignored the price action, the short term, have all made money as long as they were patient enough. And I think that never changed in the past 100 years. I mean, we've been doing the same thing for the past 100 years. You want to buy good businesses. The only thing is, I think, and tell me if you agree with me, I think a lot of retail investors misunderstand this point, where the hunt for the perfect entry point. This is my biggest problem when I talk to people. Is like I explain, hey, if you're trying to, if you're a long-term investor, let's say a DCA guy, you want to be in the market for the next 15 years. I mean, you shouldn't be looking for entry points. You just want to dollar cost average into a good business. But what about what's your position on arguments like, for example, a company like Palantir? I know you don't talk about specific stocks. I'm not going to ask, but a lot of companies right now with a triple-digit P ratios, and people are saying, "Well, that's too expensive. That's ridiculous. You shouldn't be even thinking about investing in a company with a 200, 300 P." So, is there a scenario where you think a three-digit P ratio still makes sense as a long-term investment?
Yeah. Okay. I got to draw two circles. Okay. Circle one is all companies that trade at 100 PE or that don't make money. Okay.
Yep.
And that's like 40% of the 40% of the stock market, like not in the S&P, but just like of
Yep.
the 4,000 stocks out there. Of course, the majority are bad investments because if a company can't make money, it's probably not worth your capital to risk. But then I want to draw a second circle. Unique, what they call N equal 1 businesses. Okay, what are N equal 1? Companies that, number one, are like laying the groundwork for a huge secular story. Therefore, they're not making money now. Or founders that are creating constantly new markets so that the current earning stream doesn't reflect the future. Okay, Tesla and Palantir
Tesla.
are
Yep.
examples. Look at
Yep.
data centers. I did wireless. Wireless was exactly that second category. They didn't make money because they were building cellular systems, but once they did, they became like huge companies.
Yep.
They should trade at huge multiples because you're trying to discount the future. Imagine if someone said, I'll only pay 10 times Tesla earnings because it's just a car company. They missed it for the last almost 7 years, 8 years. So that category, you have to start with a different mindset, which is find unique founder-led businesses and then determine if the multiple is reflecting the discount to the future. So those cases, I think you can pay 100 times. But the other circle, all companies that don't make money and trade 100 times, 99%, of course, are not great businesses. So
That's the
I'm
difference
trying to
between
answer it, but that,
99 and
yeah.
2025, right?
Huh?
99, the vast majority was the second circle, where very expensive businesses that didn't generate cash flow. And now in 2025, most of these hype companies, they're still generating a lot of billions of dollars in cash flow.
Yeah. So I think that like the companies you want to own are like the circle where it intersects. The N equals 1 founders, and then they might have high multiples, but that they're actually good investments. Like Palantir is a great investment. Nvidia's still actually really cheap.
People don't
Tesla.
remember, but you had Palantir in granny shots multiple years ago. I remember because
Yes.
I'm a paid FS Insight member. By the way, they gave me one for free now. Your team, but
Yeah.
I've been a paid member for years. I remember seeing on the granny shots, seeing Palantir years ago. But I do want to ask you this question, Tom. I don't want to put you on the spot here, but look, people are saying, look, Nvidia, Palantir, GPUs, it's all very concentrated, right? And that's a huge sign of a bubble because this rally is too concentrated. Do you agree with that sentiment?
Well, AI is a scale business, meaning you got to have a lot of money. Like you and I can't make a competitor to OpenAI. Like us in our garage. Like we'll make something that looks cool, but it's never going to compete with OpenAI. So it's a scale business. A scale industry is something like energy or banking. There are only 8 oil companies in the world. Literally all the capex for all the refiners. Like there's only 8 people that buy oil in the world. What if someone said oil's a circular business because there's only 8 companies buying oil? Like we'd say that's ludicrous because you got to be big to be drilling for oil, and like
Yep.
you got to be a major. Guess what? That's AI. It's a scale business. That's what this is showing. And do we want Nvidia to be dealing with like hundreds of thousands of tiny little companies? I'd rather they be dealing with some big companies that can deliver stuff, and then there's ramifications, and then to ensure the financial viability. So I think it makes sense that there's this taking place. I think it's really logical.
Yeah, I tend to agree. And Tom, flipping, we talked about how most experts. By the way, I gotta be honest, myself included. I thought 2023 is going to be a subpar year. And I'm on record saying that I got it wrong, but I'm in a good company because everybody, for the most part, got it wrong except a few. So you called it, and you keep calling it correctly. What did the past 2 years in the market, even though you've been doing this for 4 decades, what did the past 2 years in the market? What's the most important lessons, I guess, for the past 2 years for you personally?
Well, the last 2 years include and this year have showed the mass delusions can persist for a long time. And I'm sorry, that's not the right word. Mass misconceptions. Because as we started this conversation, the reason people were bearish for the last few years is they thought that we were having a recession. They couldn't explain it because they didn't see it in the companies, but they were so sure because of the yield curve. And by the way, that made companies cautious, right? So companies forced themselves to change, and then people were convinced inflation was going to explode and just never go away. That is a massive like disconnect from the actual underlying data. Because if there was massive inflation, companies couldn't even make money, and they were doing fine. And remember, people said banks would go bankrupt because of the curve was inverted. Banks made a lot of money. So there is, I think, still this reflection that human behavior doesn't change. I mean, people believe something and they get anchored to it, and then most of the time when the data disagrees with them, people choose to believe themselves than to actually believe the data. I think the reason Fundstrat actually stayed bullish was that we weren't anchored to our view. We were anchored to the earnings, and the earnings came through. And people call us permabull, but earnings have been on a perma rise. I don't know what to say. You know what I mean? Like if someone, I'd say that we've been following a different set of data that really ultimately drives stock prices.
Would you agree to me recapping this as a ego when people
Yeah, I
get
think.
they
Yeah,
get into a position and then like they fight for it?
yeah. I think there's something that I think is important, and we speak about a lot, which is there's a difference between having conviction and being stubborn. And being stubborn is like what you're saying. People believe that they're smarter than the stock market, whereas conviction is anchoring on the correct thing. By the way, remember, in a room of geniuses, the best you can be is average.
Yeah.
So, no, like if someone thinks they're smarter than the stock market, they have to realize it is more than a genius. So, we don't try to outsmart the market. That's Fundstrat lets the market tell us how to be positioned. I know it sounds backwards.
It's funny. People don't learn history, but a couple decades ago, Peter Lynch famously said that more money was lost waiting for corrections than money lost in the corrections themselves. And he's kind of the goat status, right? With his, I mean, I don't think anybody outperformed Magellan over the course of his years. I mean, what, like 30% a year, something crazy like this.
Yeah, that's a gold standard. And today there's folks like that, David Tepper and uh, you know Stan Druckenmiller. I mean, those guys have, of course, enviable track records. And by the way, I mean they're all examples of like they will counter trade the market. Earlier this year, Nvidia was like 90, you know, and people didn't want to touch it at 8,
Yeah.
at those levels. And and then as soon as Nvidia is down 10%, people don't want to touch it. I think people really have to realize their emotions are forcing them to be stubborn rather than having conviction.
One of the things I wanted to teach people who come in and try to work with me is like this idea. Think about the stock market just like you think about any other place where you're procuring either services or goods, right? If you come into to the app store and they're selling the iPhones at a 30% discount, that's usually a source of excitement. But somehow in the stock market, it's this reverse psychology where now all of a sudden, well, the iPhone doesn't look as good anymore because it's discounted, and you're not even looking at the underlying fundamentals. I think. Where do you think this stems from? This inability of people to look at stocks and the stock market in general fundamentally, and instead of doing it more emotionally.
Yeah, it's a good behavioral question. I think it reminds me of, and we cite this a lot at Fundstrat. The Japanese word for crisis is kiki, and so crisis actually has two words. It's two kiki is two words: danger and opportunity. So most people in a crisis only focus on the danger. So like when markets are down, people are only thinking of the danger to their portfolio or that they think, oh my gosh, I'm not, I must be missing something because I'm so convinced something's a great idea. It should only go up every day. But the reality is they should view that as an opportunity because the markets will give you opportunity. So, in Fundstrat's world, we always have to balance that. We know there's danger, but we see opportunity. That this year was a really good example of that February to April period during the tariff crisis. Many people went too far on the other side and said, we're going to have a recession or everything's over or Trump is going to ruin the economy.
Yeah.
But they didn't see the opportunity and they only saw the danger.
And you pointed this out. I remember in April, you said, hey, look at the sentiment surveys and break it down by political affiliation, and you'll see it's politically motivated, not actual sentiment. I remember that from April.
Yeah, it's that didn't people took a lot of offense, Tom, when we did that because we showed that the country is 50-50 Republican Democrat. It's really evenly divided, but this consumer sentiment surveys actually now become really extremely Democratic leaning. 66% of UMich respondents are Democrats, but
Yeah.
the Democratic respondents had the worst reaction to everything, and the stock market can't discern that difference. I think that we have to remember companies, it's better to think of the market as companies, not your political view.
Yeah, and it's we're not going to talk politics here, definitely not. But you've been utilizing politics a lot at Fundstrat over the past year,
Mhm.
and working the market based on how politics play out. And it's funny how some people refuse to do that because of like the inability to disengage political affiliation opinion versus making money in the stock market. It's weird, right?
Yeah, and again, Tom,
It's like betting against a team that you're a fan of. You know what I mean? It's so hard to do.
mm,
When you're a fan of a
yeah,
team, it's like it's hard to bet against it.
yeah, and I think you said it earlier. There is a lot of ego in investing because, like, there's a lot of thrill when you like a company and you like the stock, and then it goes up because it's confirming. And then if you like an idea, but the stock goes down, then you start to question, you take it, like one might take it personally, like, oh, what am I missing? Or the market's crazy. And so there's a lot of emotions that get involved. And I see that at work. Everyone suffers from that. And machines, by the way, aren't going to fix that because machines have a similar bias, by the way. There's, because machine.
They're built in our image, so they're gonna make the same bias we do.
Yeah, and everyone has a recency bias. Machines still have recency bias because they're going to overweight the last 5 years, 10 years, or they're
Hmm.
going to wait shorter cycles where there's still so much more noise. So I think that's why you have to step back and then think of super cycles and long term. Like if Palantir is down, does that change Alex Karp's mission? If NVIDIA is down, does that change that AI is like, a super cycle? It doesn't. So then you just have to look past that. And it's true in crypto too.
Especially in crypto, because the
Yeah.
sentiment there drives everything. So I want to let you go at 9 because I know you have something. So we have a few more minutes, and I want to end with this question, and Tom, if you may, if you had to describe based on what we know today, obviously there's the unknown unknowns, right? Based on what we know today, if you had to describe the stock market for the next 12 months in one sentence, what would it be?
Mm. Well, I'm going to say just buckle your seatbelt, okay? Because in the last 5 years, the market has gone up a lot, okay? Or the 6 years since 2019. But we've had 4 bear markets. So we have a bear market every year. That's going to test your resolve. So I think people need to just buckle up because I don't think next year is any different.
Can you just give
2025,
me a
yeah.
sorry, Tom, go ahead, go ahead, go ahead.
I
Sorry.
was gonna say because 2025, remember we were down 20% at one point, and then we've come back and we're up. We're going to probably be up 20% for the year. So just keep in mind, it could happen again, or very
In
likely will.
April, as a I'm a very heavy into Palantir. In April, we were down 50% this April on Palantir.
Wow.
When the tariff scare, remember the tariff scare where everything was over, the world was ending. So I couldn't agree more. And you just gave me a wonderful YouTube title for the next video. Tom Lee, buckle up,
Mhm.
in all
Yeah.
caps.
Yeah.
That's the perfect. You should do YouTube.
Yeah. Yeah.
Tom, I want to thank you for coming on today. I want to be respectful of your time. I know you said you have a little bit, a few minutes, but I want to do this again if you may, in a few months, possibly to have you come back and talk about what's going on. I
Yeah.
absolutely love your work, and I hope that we can do this again. But I just want to kind of the final question to you. If you had to give kind of this one piece of advice, not financial advice, this is a different question, one piece of advice for people who started investing after 2023. There's a lot of new investors in the market that haven't seen a serious pullback. So anybody who started in 2023, 24, or this year, what's your kind of one word advice for these folks that have not seen a real market yet?
Yeah. Well, yeah. So first, Tom, you do good work, so I'd be glad to do your show again. But I don't know
Much
when.
obliged.
It's just I'm, very overscheduled. But I would like to do it again.
Thank you so much, sir.
The advice I would give is the it's great. Markets feel great when they're rising, but there are going to be very long periods of time where it's misery and you're going to question yourself. But that's when you need to have resolve and conviction, because more money is made when you can invest at the lows than trying to only trade this at the highs.
Couldn't end it any better. Tom, thank you so much for coming on today. I think you dropped a lot of wisdom on us and our community. We appreciate having you on. And as you said, you're welcome anytime. And this probably becomes a YouTube video, which I split up to like 5 different videos
Mm.
for the next 2 weeks, based on the amount of headlines. But thank you so much, and yeah, have a great rest of the week.
Thanks, you too, Tom.
Bye, Tom.
Yeah, bye.